This is the mechanism that has been put in place to essentially take all of our money. Every IRA, every brokerage account, every 401k is completely vulnerable of being taken in the event of a widespread custodial or banking collapse. Now, when people first hear this, this is what's going on in their head. That's ridiculous. Take your tinfoil hat off. Let's get back to, planet Earth. That's not gonna happen. Well, here's the deal. It has already happened dozens of times in our country. What happens when the interest rate on our bonds is so high, the lack of trust is so big that they're not going to get their principal back, that we just can't bail ourselves out again? That is when the widespread custodial collapse happens, and that is when I think the great taking is going to take place. But this is one of the best solutions to the upcoming Great Depression, the upcoming great taking, market volatility, and low fees. And that answer, now this may shock people.
Welcome back to Liberty and Finance. I'm delighted to have a first-time guest today, Andrew Winnett, who is a certified financial fiduciary and the owner of Retirement Renegade, also a producer of the film Retirement Reset movie, which has a cast of people who need no introduction. We'll hear more about that in a moment. Joins us this first time on Liberty and Finance. Today is Tuesday, July 14th, 2026. Andrew, thank you for coming on Liberty and Finance this first time.
Thanks for having me, Dunnigan.
We were delighted to see you introduced to us by Alex Newman, who is our mutual acquaintance and a regular contributor on Liberty and Finance. He alerted me through your interview with him to the work that you're doing to warn ordinary Americans who are late career stage and retirement age, which represents the bulk of our viewers and subscribers, who will be highly interested in the cautions that you're getting out there in your movie, the Retirement Reset movie. Can you tell us about what got you into that, and who some of your key contributors are on that movie, and what some of the key messages are that people will find out if they watch it?
Sure. Well, I heard about this concept of the great taking last year. I was in LAX in California. I was coming back from a mastermind, and it was early, and I had my coffee and my banana, and I'm watching YouTube, and I listened to a lot of financial stuff, and I came across this interview, and it was from a gentleman by the name of David Webb, and he was talking about how your bank accounts, your custodian accounts could be legally taken in the event that the bank or the custodian were to fail. And I was like, come on, that's ridiculous. I've been in the financial space since 2007. And I actually was starting to dip my toes into that world and lost people's money in the investment side in 2008. It was a very painful, difficult experience. But I never heard of this insane, wild, ridiculous concept of your money being taken. Well, I never buy the Wi-Fi Dunnigan on the plane. I think it's a freaking ripoff. But I decided to buy the Wi-Fi that day on my trip home. And I just couldn't get enough of this idea of the great taking. And what really gripped me and why I bought the Wi-Fi was it was documenting this legal battle that took place in my hometown of Nashville. I live in Franklin, right outside of Nashville. Our office is headquartered just outside of Nashville. And it's talking about this legal battle that took place in 2024. And ultimately, the bank lobby won, and they shut it down. And so it got me interested in learning more. So I get home and I start really diving into this. I get David Webb's book, The Great Taking. I read it. I watch this documentary. Then I learn about James Patrick's documentary, Stop at the Great Taking, which documents multiple legal battles in Tennessee and South Dakota. And I just couldn't believe it. And so I started, as I went deeper and deeper and started talking to attorneys and started looking into this stuff, sure enough, every IRA, every brokerage account, every 401k is completely vulnerable of being taken in the event of a widespread custodial or banking collapse. The way it works is when you give, let's say, for example, Dunnigan, you have $1 million and and you invest in Fidelity, let's say, and Fidelity's a good company, and I'm pulling Fidelity out of a hat. They're all this, any custodian, any bank, you fill in the blank. You invest $1 million at Fidelity, and let's say you wanted to buy Microsoft stock. Awesome. I invest $1 million also at Fidelity in Microsoft stock. What happens is when we give Fidelity that $1 million, they take it and they pool it at the Depository Trust Company out of New York, or the DTC for short. There's over 900 participants at the DTC that use the DTC. Well, the DTC is an interesting organization. Alex kind of goes into details about the gentleman that started it being a part of the CIA, also having ties to the origins of USAID, which we heard about recently. A lot of fraud and, sinister things coming from that. No financial background, yet all of the world's money is pooled through this organization. And so you give the $1 million to Fidelity, you buy your Microsoft stock, your stock then is pooled at the DTC, and what happens is it's no longer your private property like it used to be when you had a physical Microsoft certificate. When it said done again, that is your private property. Well, when it was digitized, there were some laws that were changed in 1994 and then amended later in 2004, where you became what's called an entitlement holder. You have what's called a pro rata interest in that stock. Now, that may seem subtle and kind of innocuous, but it is very important when it comes to the legal world. Because if something happened where Fidelity were to go bankrupt, which would only happen if one of their wild bets were to go sideways, well, we've got a problem. So what happens is basically this. Let's say, for example, Fidelity wants to grow their business, which they all do. Well, how do they grow their business? They're going to come up with fancy derivatives contracts, maybe do some options, invest in hedge funds. They're doing all kinds of crazy stuff. And as long as it all works out, the profits are privatized. They get to keep all the profits. But if the bets don't work, the losses are socialized. And the way it works practically is, let's say that Fidelity were to grow, they want to grow their business and they're engaging in derivatives contracts, and JP Morgan, let's say, steps in and says, okay, Fidelity, we'll fulfill the other side of the derivatives contracts, but if we do this, we're going to need some collateral. Now, what is Fidelity going to use as collateral? They're going to use your and my private Microsoft stock that's been pooled at the DTC. So if the derivatives deal doesn't work out and it goes sideways, Fidelity's going to go under, JP Morgan can legally step in and take back your and my private property as collateral. Now, when people first hear this, this is what's going on in their head. That's ridiculous. Take your tinfoil hat off. Stop being an Alex Jones conspiratorial weirdo. Let's get back to, planet Earth. That's not going to happen. Well, here's the deal. It has already happened dozens of times in our country. And we have the proof. That's why I did this movie. Because once I started learning more and more about this, I believe that this is the mechanism that has been put in place to essentially take all of our money. Any bank, any custodian, that's basically 90% and 95% of most people's money, if not more, at least liquid money. So I created this movie. I spent $1 million of my own money. We got Tucker Carlson in it, Ben Stein, ITR Economics, Alex Newman. We have Justin Haskins. We've got Tom Hegna, Cheryl Moore. We've got Roy H. Williams, who wrote the book Pendulum, which maybe we'll talk about that. That is a fascinating rabbit trail to go down. But bottom line, guys, is this. It would be as if you were going to go buy a new vehicle. Let's say, for example, that Dunnigan, you wanted to buy a brand new Lexus, right? And you go and you pick out your new Lexus at the dealer, and it's exactly what you wanted, and you paid for it with your cash. And you drive it off the lot and it smells amazing and it's smooth and it's got all the leather, and You park it in your driveway and you're going to go on a bucket list, road trip the next day, and you can't wait to drive your new Lexus that you just purchased. You go to sleep, you wake up the next day, you peek out the window, and oh my gosh, my Lexus is gone. And you're freaking out. You call the Lexus dealer. Guys, we got a problem. My Lexus has been stolen. Well, the Lexus dealer says, here's the deal, Dunnigan. I know you bought this Lexus in cash, and I'm sure you loved it driving home. But the problem is there were some state laws that were changed that actually gave us as the dealer the ability to bet on these crazy investments. And we were able to use your Lexus as collateral for our risky bets. Well, the risky bets didn't go our way. We're going under as a dealership, and the third party took your Lexus as collateral. You would be like, what the heck, dude? This is illegal. This is unconstitutional. This is un-American. You can't do this. That is exactly how it works in the financial system.
So the point is not that people should be freaking out about their cars right now, but that you're pointing out, imagine how upset you'd be thinking, I bought something in cash, I own it, I have legal title to it, nobody has a right to come take it away from me, I already paid for it. But you're saying that's precisely what mom and pop USA with their stocks, bonds, mutual funds, in their retirement accounts, in their regular brokerage accounts, and in their IRA brokerage accounts, and in their 401k brokerage accounts. That's the status. That's the legal and financial status of all of those things you think you own in those accounts. Is that what I'm getting?
Yes, you don't legally own it, technically. You are an entitlement holder. And it's so subtle how they did this, because if this was a law that was federal, they could come in one swoop. You get the right president, the right administration, and they just solve the problem. But they did this in every state. We fought this. I actually fought on your behalf, Dunnigan. I fought not just on behalf of the Tennessee residents, but for the residents of the United States, because if we can solve this problem and amend these laws in one state, it will be the domino that other states follow. So we went down, this is part of the movie, but we fought against the bank lobby in March of this year, and we lost 5-2. And if you heard their reasoning, it is infuriating. The bank lobby is so powerful. Like they're so, I don't know what's going on behind the scenes. I don't know if there's envelopes being slid across the table. I don't know. That's conjecture, but it's very difficult to beat them. And it really is a David versus Goliath story. But until these laws are amended, all of our 401ks, our IRAs, our brokerage accounts, our bank accounts are vulnerable of being taken in the event of a widespread custodial or bank collapse. Now, the question then becomes, okay, well, what is the economic conditions in which a widespread economic or custodial collapse might actually happen? And that's what the movie talks about in the middle, which is we believe that there is going to be a Great Depression, maybe even call it a Greater Depression in some ways, coming around 2030. There's 5 big reasons why. ITR Economics also really kind of spearheads this idea, but the 5 big reasons, the first and foremost and the most important is demographics. We have such a swelling elderly population, we don't have enough taxpayers to cover the rising costs of the boomers aging and passing on. And demographics are kind of like the Titanic. You just can't turn it around on a dime. It takes time. And so the demographic issue is very real. As people age, they're no longer contributing to the tax base as much as they used to, and now they're taking more. And so demographics, number 1, which leads into the other 4 issues, which is healthcare. We believe that healthcare is going to reach $8 trillion by 2028. Inflation, obviously, you look at the CPI, I call the CPI number. It doesn't factor in the realistic rate of inflation. Allegedly, it just went down. I just saw it today. But it's still almost double what the Fed's stated goal is. So inflation's here to stay. We actually think that inflation is going to peak around 2032. We'll have 2 years of disinflation and then 2 years of deflation after that. You've got unfunded liabilities. This is goodness, you could Google this. Between Social Security disability, Medicare, Medicaid, government pensions, we have somewhere between 150 and 200 trillion in unfunded liabilities over the next 75 years. We only bring in 5 trillion approximately in tax revenue per year. How are we going to pay for all this? And then fifth and finally, and this is the big one, is our government debt. You know, we're knocking on the door of 40 trillion. And so again, going back to that original question, what would be the economic conditions in which a widespread custodial or bank collapse might happen? Well, when you factor in 2008, September of 2008, Lehman failed. In October of 2008, we came up with the TARP program. And so what the TARP program was, is we printed $700 billion and we infused capital into the very rascal banks that got us into that mess to begin with. We stopped the contagion. Now at the time, 700 billion was insane. We couldn't fathom that kind of big number. Now we print 700 billion like every 65 days or something. I mean, it's insane. But we printed 700 billion, we stopped the contagion. But see, at the time, we only had about 10 trillion in United States sovereign debt. We still had room on the credit card to bail ourselves out. What happens when we don't have room on the credit card? That's what I'm concerned about. That's what I brought up at the legislature here in Nashville. We're at 40 trillion. According to Congress.gov, they're saying that within 5 years, 50 cents of every dollar that we bring in tax revenue is just going to go to the interest expense alone on our debt. And within 10 years, 100 cents of every dollar that we bring in tax revenue is just going to go to the interest expense alone on our debt. We will not have any more room on the credit card to bail ourselves out as a country. I'll kind of end this idea with what happened in early 23. Obviously, you're very familiar with this, Dunnigan, but when interest rates popped up in 22 because inflation was to the moon, Silicon Valley, Signature, and First Republic Bank failed, right? That kind of whiplash in the interest rates, it is devastating for banks. A lot of people don't realize this, but between those three banks, there's a couple other smaller ones that failed, but those three big ones, Signature, Silicon Valley, and First Republic, they had over $500 billion in defaults. They actually had more in defaults than the entire global financial crisis that we were able to stop with the TARP program. Now, people don't understand FDIC. FDIC has less, at the time, had less than 200 billion in insurance coverage, but there was 500 billion in defaults. So 2.5 times more in defaults than FDIC had in insurance coverage, which is why the Federal Reserve stepped in, backstopped them, gave the good assets to JP Morgan, took on the bad assets. They gave them a sweetheart deal, and we stopped the contagion in 2023. The Fed bailed us out again. We still had room on the credit card to do so as a country. What happens when we can't do this? What happens when the interest rate on our bonds is so high, the lack of trust is so big that they're not going to get their principal back, that we just can't bail ourselves out again? That is when the widespread custodial collapse happens, and that is when I think the great taking is going to take place.
To remind our viewers who haven't heard the story, that my wife and I personally were informed by our stock brokerage, which was TD Ameritrade, and after the global financial collapse of 2008, it was in September, we got a notice saying, until further notice, you won't have access to your money market deposits that are on file with us at the money. It's called the Reserve Primary Fund, and that was in September of 2008. It was the first money market fund that broke the buck, that failed, and they were collateral damage because of the Lehman Brothers collapse. And I called up the broker. I said, "This doesn't make any sense. We weren't in the market. We didn't own anything to do with Lehman Brothers. We were just in this cash equivalent money market fund." He said, "Well, you weren't, but that's how your fund made the profit so that they could pay the interest rate that you were enjoying in that fund, is that they were doing stuff on the back end and they were collaterally damaged from Lehman Brothers. So until further notice, you don't get any of your money back. We'll let you know when you do." And over by dribs and drabs over a period of quarter after quarter. We got 50% back, and then 20% more back, and then 10% more back. We never got it all back. And they would call me up annually after that and say, hey, we noticed you haven't been doing as many stock and option trades as you used to. Is there anything we can do for you? I said, yeah, when do I get my money back? They said, is there anything else we could do for you? So that's already, even before all of the new laws for the great taking were put in place to make sure that this was the case across all asset classes that are under management. It was just the fact that you may think you're not taking on personal risk if you think you have a money market fund or some other safe thing at your brokerage account, but you have no idea what that fund is doing on the backside. For those, most of us who don't understand the detail of the prospectus, and you have no idea what your brokerage is doing on the backside with these pooled investments and that sort of thing. So just to remind everyone that this is a very real thing that has and does happen. And you've just told us about this perfect storm that we're heading into now, where the exposure and the risk and the fragility of our financial backing of our country and the banking system are on much shakier ground than they were then. And many ordinary moms and pops are much more dependent now than they ever were on for their survival on their savings, because the Social Security hasn't been keeping up with the true cost of living increases and so on. Any more comments from you on the situation that many retirees find themselves in right now before we move on to some of the newest developments that have just come out in the past month or so?
Yeah, a couple comments. So one of the things you talk about, Lehman Brothers. So Lehman was the biggest example of the great taking in a controlled way. So what happened with Lehman Brothers, we actually talk about this in the movie, and we have the documentation to prove it, as well as Justin Haskins in his book, The Next Big Crash, which is a great book. I highly recommend it. What happened with Lehman Brothers is JP Morgan was using some of the accounts were collateralized or used as collateral, if you would, for some of these risky investments that they were engaging in Lehman. Well, when it didn't work out, JP Morgan stepped in and took back the collateral, which was everyday investors' private property. It was middle-class America. Their money was taken, and when we printed the TAR program, we stopped the contagion, we infused capital into the rascal banks that got us into that mess. And even then, even though they were bailed out, Lehman Brothers was bailed out, many accounts did not get made whole for 14 years and 13 days. They didn't get cost of living adjustments. They missed out on one of the greatest bull markets in history, and some of them were not even made whole at all. So again, that was in a controlled environment with a bailout. What happens when it's widespread without a bailout? And that is what my concern is. I'll leave you with these couple final thoughts, 3 thoughts. The first thought is, I talk to everyday boomers, all the time. I mean, that's my job. We're a nationwide company. We help people across the country. What is so interesting to me is how do I say this politely? The short-sightedness of headlines. In other words, if the market is green, if I look on my phone and I see green, I am in a good mood. I am happy. I am making money. If I look at my phone and I see red on the Dow Jones or the S&P, I am not happy. If I see bad headlines, I am not in a good mood. The market is so short-sighted, and boomers in many ways comprise the market. They have all the money. And so if Trump has some good tweet like, oh my gosh, we just keep winning in Iran. I mean, all we do is win. I'm getting so tired of winning all the time. Everybody's happy. What they're not focused on is what is coming down the pike. There's a proverb, I put it in the movie. It says, a prudent man, I would say also, or woman, foresees calamity and prepares themselves for it, but the simple move forward and get wiped out or punished. It's very important we do not have a normalcy bias where everything has been good, therefore everything is good right now, and everything has to and always will be good. So dangerous if you believe that. It's a dangerous precedent, but most financial advisors are eternal optimists. They believe that trees grow to heaven. They believe that the market is never going to go down. We've been lulled to sleep. We've been seduced, intoxicated by this market that is 100% smoke and mirrors. It is not based in reality. I still think that there can be market upside for sure, but it's unwise for us to think that somehow we're the exception to the rule. Every other empire did all X, Y, and Z that led to its demise, but we're different. We can get away with it because we're America. Please, that is hubris, that's arrogance, and that is what leads to the final stage of the empire. So I am optimistic. I'm not like this doomsday, there's no hope. I actually am very optimistic. We have solutions, but you just have to know how to think about things. And I'll leave it with this. It's very important that people do not get lulled to sleep by the headlines. You have to take a balanced approach. Look at both sides and always be trying to kick your own butt. Where is the curveball coming from? Because it is coming. And boomers who've lived long enough know, hey, peace and safety and then sudden destruction seems to come. That is a normal reality, a normal cycle of life. So just challenge people. Don't have the normalcy bias. Don't have ostrich syndrome, putting your head in the ground and just pretending nothing's going to change or nothing bad is going to happen. You need to take this seriously because, hey, this is all the money you have. You're unemployed by choice, and no one wants to be forced to go back to work or, as Ben Stein said in my movie, pick up used cigarette butts and try to sell them.
We had the pleasure of meeting Ben Stein in person in Los Angeles. That was a great honor. Wanted to get you to weigh in on some very recent rule changes that have, I would call it IPOs for everyone, where previously only those investors who met very stringent criteria were able to participate in initial public offerings of new companies' stock being offered to the public. But just recently, rules have been changed so that ordinary investors in their IRAs and 401ks can participate in receiving shares of initial public offerings, such as SpaceX and AI stocks and so on. This has been touted to mainstream USA as, hey, this means you can participate in the new economy. You won't be left behind by the billionaires who have limited privileged access to things you don't have access to. Help us understand the truth behind that and the unexamined risks that this may be placing ordinary retirees and investors in, that they have no idea what they're being led to, and how it could end up being, as John Rubino calls it, exit liquidity and the bag holders for those who got in much earlier than the initial public offerings.
Yeah, so IPOs to the untrained eye can seem like the way that you get super rich. And by and large, in times past, that has been the case. If you are able to get in on the ground floor, then you can make a tremendous amount of money. The problem is that for most Americans, I'll call them, Main Street, middle-class Americans, they do not have the qualifications. They don't have enough saved. They don't make enough per year. They don't have big enough net worth to qualify to be a pre-investor in these IPOs, these initial public offerings. So what has happened, again, you have to understand the dynamics prior to this. Going back to 2021, the Department of Labor made some changes around 401ks that actually were a little bit more on the restrictive side. And then in 2026, with the Trump administration and the Department of Labor working in tandem, they eased those restrictions in a very big way. And they also worked with a lot of the index fund managers like the NASDAQ, Russell, and also the S&P, where these IPOs, like SpaceX, ultimately Anthropic, OpenAI, they're coming. They're down the pike here in a little bit. But you will be able, when you buy the Russell or the NASDAQ or the S&P, you have exposure to these tech companies. And that seems like a wonderful way for everyday Americans to have some upside, right? Well, think again, because here's what's really going on behind the scenes. You have all these billionaires, all these institutional investors who have invested in private equity. We all know the big names: Blackstone, BlackRock, you've got Apollo, Blue Owl. There's a bunch of them. And what has happened recently is the redemptions have been essentially, by and large, shut off. The reason why they've been shut off is these investments that these private equity funds are investing in are not doing so great. And so the redemption periods have been completely shut off or gated or restricted. And so imagine if you're a billionaire or an institutional investor and all your money's tied up and you have no liquidity. You can't get any of your money back. Well, this is kind of scary. So what they need, these big, the top 0.001%, they need liquidity. And so what they've done is they bought into SpaceX, let's say, at 1% of what they're going to sell it to us for. They go public in June. They have a 6-month lockout period. Sometimes they can get some money out a little sooner, but most of it's around 6 months. And then they can cash out, right? Then they get their liquidity. So during that time from June to December, everybody who's contributing to a 401k, which is tens of trillions of dollars going into 401ks, 403bs, 457s, and thrift savings plans, all of a sudden have exposure to SpaceX, because if they're investing in a general fund, a general index fund or market fund, like the Russell, like the NASDAQ, like the S&P, ultimately, they're not quite on board, but they're in process, they get access to SpaceX. So all this money inflates the price, and then come December, the rug's going to get pulled out. It's a way for Wall Street to transfer the bag of risks to Main Street. It's a way for them to get liquidity, and Main Street is holding the bag. Again, Wall Street is all about looking for giant buckets of money and figuring out how can we get our greedy little hands on that, unadulterated bucket of money. That's how they work. You look at the pension plans, you look at the 401k plans. I mean, they are doing everything to get access to our money. So the SpaceX and ultimately Anthropic and OpenAI IPOs that are coming down the pike, I'm concerned about, because when you're trading at 100 times earnings, which is what SpaceX is trading at, that's a bubble. You look at you look at the Magnificent Seven, they were trading between 20 and 40, and really it should be more like 20 to 30. That's a healthy PE ratio. We're trading at 100 times, and it's brand new. I'm concerned about it, and I'm concerned that people are not aware of it. In fact, many people don't even know that they're exposed to this risk because they're just investing in their normal 401k plan, and they don't know that all of a sudden they're automatically buying SpaceX, ultimately Anthropic, and OpenAI very soon. They had no idea. No one told them this. They didn't get a notice. They're still investing in the same index fund, but all of a sudden the index fund changed, and they had no idea.
And just on a current note, today, we're recording this Tuesday, July 14th, is the single biggest one-day loss of, for example, IBM went down the greatest percentage of its value lost today since 1968. So to not think that these things can expose you when there's been these high-flying tech phenomenon. In fact, if that's one of the things that you could also touch on, is the ratio of buying to selling by high-flying tech CEOs over the past year plus. We've been told that the market breadth has been terrible, and in the past that's typically been an indicator, a forward indicator of future market turmoil ahead, when you start to have just a few leaders holding up the entire index, like the Dow Jones or the S&P 500, and most of the stocks not and struggling. But then when you have the leaders, the CEOs of those high-flying companies that were the ones holding up the index, outselling their acquisitions by by multiples. Can you tell us what you've been watching and what that may indicate to ordinary moms and pops who think everything's fine in Wall Street the way the financial press seems to tell them it is?
Yeah. So I'll say this. I am not a guy who studies every single tech stock, because in many ways I am a pessimist. I will believe it when I see it. I will believe their value when I see the value that they're providing everyday people, right? I just do not invest in things that are overvalued. I think that if you look at some of the circular deals that have happened over the last year, where, the easiest way I explain this to clients is, let's say, if I gave Dunnigan $100 and Dunnigan gave Brandon in my office $100 and Brandon gave that original $100 back to me, did our net worth go up by $100? No. We just moved money around. It's just, no one's net worth increased. But that is exactly what has happened with these valuations with all these tech and AI companies. I'll give you $100 billion, Dunnigan. You give Brandon $100 billion, and Brandon will give me that same $100 billion in a fancy way, and all of a sudden our net worth went up by $1 trillion. This is exactly what's happening. It is not based in reality. To your point about how there's just a couple winners that are holding up and propping up the S&P and these different indexes, if that's not a red light to have some caution. I mean, for example, DeepSeek, right? When DeepSeek came out, China's version of ChatGPT, and they built it for like $20 million or something. I believe this has been a little bit, but NVIDIA dropped like $400 billion in one day or something like that. It was insane. I know that SpaceX, I was tracking the first week, and I remember SpaceX lost $500 billion in one morning. It's just like, how is this? We're dealing with funny money here. Elon Musk is a trillionaire, then he's no longer a trillionaire, then he's a trillionaire again. We're living in a fantasy world here, So I'm concerned. It feels a lot like the dot-com bubble. And it's just, we're pulling numbers out of hats, and people are believing it. The hype again, if people are optimistic, you should be, this is what Warren Buffett says, I'm paraphrasing, but if people are being greedy, you should be scared. If people are scared, you should be greedy. If people are so bullish on these AI stocks and so bullish on the S&P 500, you might want to be a little bit timid and defensive. And that's all I see. I mean, again, Trump knows the market. I believe that he's trying to hold everything together with popsicle sticks and bubble gum until the midterm elections. Also, because Anthropic and OpenAI are going to have these IPOs. And we've not solved the problem in Iran. People, don't want to talk about this, but this is the chickens are going to come home to roost with Iran and with the oil situation. All of that is going to play a role in the overall stock market. And if inflation continues to go up, which it is and which it will, and the bond yields continue to go up, it is going to have a negative effect on the stock market, namely AI and tech companies. So there's choppy waters ahead. There's some, storm clouds ahead, I believe. I think we could have a couple good months because Trump knows how to kind of hold everything together. But I believe that around the end of the year, or maybe even early next year, I think that things are going to start breaking because you just can only hold this house together with popsicle sticks and bubble gum for so long. The winds are coming.
That's what I wanted to talk to you about next. If you could talk to us, we've heard various strategies suggested for ordinary people who've been responsible their whole lives. They've worked, they've saved, they're trying to plan a better financial future for themselves, for their children and grandchildren, and trying to be productive members of their community. And yet it seems that there are so many traps and snares that are being laid out there. There's so much potential volatility ahead that it's very challenging to know what to do to reduce the risk of uncertainty on one's personal and family's financial fortunes going forward. Specifically, there's been some suggestions about if you have a deflationary recession, depression, that actually paper cash can be handy to have on hand, because some of that wealth that just disappears will reemerge in things that are at least physical. Other hard assets like gold and silver, other strategies, whether it's owning land, having real relationships with people who have skills, and having your own skills. What group of strategies do you suggest that people seriously consider to reduce their exposure to these risks and volatility ahead?
So I will say I got clients from 500,000 all the way up to 50 million. Okay, so I've got a big range. What's interesting is that I seem to attract people who, they're not against risk. I'm not against risk, but they want some hedge. They've risked to gain what they have. The last thing they want to do is risk to lose what they've obtained. And so we have a common thread. This is talk about the movie. Again, we'll give everybody access to the movie in a moment, but we find that there's a group, a bucket of investments that we recommend. First one is gold and silver. And I'm not talking paper gold and silver, okay? And maybe we'll talk about that later, but I recommend physical gold and silver that you can control. This is a hedge against the worst case scenario. I am not a gold and silver expert. I will say that up front, but I believe in it because it's God's money and it always retains value. I believe that it's going to continue to go up over time. I'm a big fan of having gold and silver at my house, not in a safety deposit box. I'm a very simple, straightforward guy. Gold and silver is important. The other thing that I recommend is real estate. Now, I talk about where real estate's going in the movie. Real estate is headed for some tough times actually over the next 10 years, but around 2035 and 2036, you are going to be able to buy real estate for a song. It is going to be a fire sale. That's the deflationary period we believe is coming, and real estate's going to be extremely affordable. It'll be the greatest money-making opportunity of our entire lifetimes. It is going to be wonderful. So if real estate is part of your portfolio, it needs to be a long-term strategy. You have to have a long-term time horizon. Otherwise, you're going to be underwater, especially if you have debt. And so you got to think through that. I love real estate. I've got commercial, I've got residential, I've got farmland. But you just got to think through, okay, well, if over the next, let's say 10 years, real estate, the value is going to be lower than what it is today, and it may be lower by 20%. Am I going to be okay? Is this going to shipwreck me? Am I going to drown here? So think through that, but real estate will always retain its value. The other thing that this may shock people, and Wall Street has done a wonderful job. The Wall Street marketing machine, again, I fought the bank lobby. I know how powerful they are. Well, there's another lobby, if you would, and that's the Wall Street marketing machine. What I'm about to share with you, people are going to have a visceral reaction. They're going to maybe fall back in their chair. But this is one of the best solutions to the upcoming Great Depression, the upcoming Great Taking, market volatility, and low fees. And that answer is annuities. Now, this may shock people. There's 9 different kinds of annuities. There are bad ones. So if you've heard negative things about annuities, usually they are true. There are good ones and bad ones. We do not like the ones that are pooled through the depository trust company and vulnerable of being taken in the Great Taking. Those are called variable annuities. We're not a fan at our firm. We don't touch them with a 10-foot pole. They have high fees, you can lose money, and they are still vulnerable to the Great Taking. We like the ones that are legally not allowed to be pooled through the depository trust company. You're able to participate in 70% of the market upside, but none of the downside. So if the market goes negative 30, you get a goose egg. Zero's your hero. Some people think, well, there's high commissions, right? That may be true on some of them. The ones that we typically recommend, they're actually low commissions. The reason why Wall Street doesn't like them is they will make 8 to 10 times more putting your money in the market and charging you a fee than selling you a safe product. They just don't make as much. And oh, by the way, the commission that the person who helped you gets paid, it doesn't come out of your money. So imagine if there was a way where you could have guaranteed income for life if you're doing an income annuity, a guaranteed growth opportunity if the market goes up without any of the downside, no fees, liquidity, and it's tax efficient because often they're tax deferred just like an IRA, or even more tax efficient than a non-qualified brokerage account. So there's 9 different kinds of annuities. We only recommend 3 out of 9. From the 3 out of 9, there's 1,300 different products. There's a ton, but I'll put it to you this way. Over $1 trillion in annuities have been purchased in America over the last 3 years. Somebody is buying annuities. And oh, by the way, all those big custodians like Fidelity, Schwab, Ameriprise, Morgan Stanley, LPL, they all recommend annuities on their website. Did you know that? All of them. You can go to it. They all recommend annuities on their website. But when you go to the advisor, they're going to recommend not buying an annuity because the individual advisor is not going to get paid as much. So if you're looking for a way to protect your nest egg, gold, silver, you want to have real estate, but have a long-term time horizon. I am a fan of land. And annuities are a big part of it because it's a way for you to be safe from the Great Taking and safe from the Great Depression. You want an A-plus rated company, by the way. The A-plus rated companies are required to keep surplus cash on hand. So for example, I talk about this in my movies and my books, but not one A-plus rated life and annuity company has failed since 1900. People will say, well, what about AIG? AIG was an A-plus rated life and annuity company. They got in trouble in 2008. What people don't understand is AIG is the parent company. They have all these subsidiary companies that are standalone. So they'll have a life and annuity side, they'll have a security side, a mutual fund division, they'll have a property and home and auto and traveler's insurance. Where AIG got in trouble in 2008 is their mutual fund division, based out of London, was selling mortgage-backed securities. They got in trouble, it went bankrupt. And we as a country, this is absolutely true, you can look it up, we as a country bailed out their mutual fund division, which is unprecedented. It's a security, right? Now, to AIG's credit, they paid back the government with interest, but their life and annuity side, their life and annuity subsidiary was completely profitable even through the global financial crisis. Not one A-plus rated life and annuity company has failed since 1900 because they have to keep surplus cash on hand in the safest low volatility investments that we possibly have, like treasuries, AAA rated corporate bonds, sometimes and often in the too big to fail banks, which there's been a precedent that has shown us that, hey, these banks are not going to fail. And then they're going to have it in cash or cash equivalents, and they're going to have it in maybe a mortgage or two on a skyscraper or stadium. In other words, if they've been through the first Great Depression, they've been around since the dinosaurs, they've gone through the last 150 years, they're the last domino to fall in an Armageddon scenario. Babe Ruth, I'll leave you with this, or I'll end this thought. Babe Ruth, his financial advisor, okay, his financial advisor saw the writing on the wall. And he saw that there was going to be the Great Depression. There's going to be a big drop. And he was trying to convince Babe Ruth to get out of the stock market. Now, Babe was very reluctant. Well, he ended up, his advisor was persistent. And he said, listen, you got to get out of the stock market. There's going to be a massive crash. And there was warning signs. There was telltale signs. Babe Ruth listened, albeit reluctantly. And his financial advisor moved all of his money into annuities. And when the market crashed and the New York Yankees were in soup and bread lines because they lost everything, Babe Ruth did not lose one penny during the Great Depression, and he was making the equivalent of $250,000 per year in today's dollars. They didn't make as much back then on playing baseball. The point is that when you look at some of these really successful, even Shaq, for example, is a massive fan. I got, just a very short clip of him in my movie. These big guys, they love annuities because of what it provides. It provides security. It provides peace of mind. It provides joy and happiness. And you're not worried about when the market crashes or the Great Depression happens. So again, to summarize, gold and silver, big fan. Real estate, if you have a long-term time horizon. This is me personally, I am not a fan of crypto. I've done really well in crypto, but I don't think that it's a long-term hedge. This is just my personal opinion. I've done a lot of research on crypto and Bitcoin and things like that. I just don't necessarily, it's a speculative investment, let's put it that way. And then of course, annuities as a big piece of your pre-tax or after-tax funds. I think that is a winning strategy for what's coming.
Andrew, we wanted to get a chance for you to remind people how they can find your movie that you just were the producer of, the Retirement Reset movie.
Yes. If you go to retirementrenegade.com, retirementrenegade.com/reset, and use the promo code CLARITY, it will be free for you. We don't want you to pay for it. Promo code CLARITY. Again, retirementrenegade.com/reset, and then promo code CLARITY. You can watch it. Love to get your feedback on it. But we're very proud of that. And again, we've got some big names and we're trying to get the word out because guys, these problems, we've got to solve them. And we actually have some practical solutions that people can take at the end of the movie to put pressure on their legislators so that we can solve these problems in every state. Because until that happens, guys, unfortunately, I hate to say it, but all of our money is vulnerable to being taken.
We'll put a link in the description of this video so people can access your movie. And we thank you, Andrew Winnett, for joining us this first time on Liberty and Finance.
Thanks, Dunnigan.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 13th through July 20th, 2026, while supplies last. First this week, Dealer's Choice 1-ounce gold bars are just $75 over spot per ounce. Next, Dealer's Choice 100-ounce silver bars are 15 cents below spot per ounce. And finally, 1-ounce platinum PAMP bars are just $125 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.